Made a website, a profit, and I'm about to make some more profit. Let's dig in. Hey guys, we're back for another episode of the $500 5-year Rags to Riches series. And over the weekend, I was able to set aside some time and been working with a local business owner. So I made a website. I netted about a $500 profit on that. It's a very simple site, so it's just a quick, like a 6-hour job. It wasn't anything major. But for the sake of keeping things realistic for most new traders, I'm only going to put 100 of it into the portfolio. So let me get my face down here and we'll take a look. And I apologize for the light here. It is about 20 degrees outside and the sun is out, so I'm not sure what's going on there, but it is messing with my lighting and I don't have my other light set up currently. So I'll fix that in a future video. But for the sake of this video, let's go ahead and dig in. So just made the website, made a little extra profit, put some of it into this. So again, if you're a new trader or if you have a lower budget, that's okay, right? This is a pretty high budget for new traders. I'm doing $500 a month contributions. I know not everyone can afford that. So I didn't think it would be fair to add another $500 in just for a project that I did, a one-time side gig. We're about 13 days into the month so far, which means that if you made about $8 to $10 a day doing something like Grubhub or maybe just little odd jobs around your town, maybe even just cleaning up parking lots for restaurants and stuff. I mean, you can find a little extra cash here and there. It all adds up. It's not necessarily something that you need to have a ton of. It's just about the consistent contributions and how you use them. So with that said, I'm adding $100 in. Obviously, from the start of the month, I had that $500 or $470 realized loss on SPX, but I get to use that for my taxes, so I don't really care. It was the last time of the year, the last opportunity for me to trade that, so that's exactly what I'm doing. Took that calculated risk. Now I'm building back into the speculative position. So now I have a total of about $116 that I can speculatively trade with for the month. So not too worried about it. Again, it was a calculated risk, and now I'm showing you guys ways to build back. So if you don't have a whole bunch of money to throw in, you can do this all the time. You just find those little extra sources of revenue without becoming a slave to making money, right? Because that defeats the purpose, right? I just happen to have a skill set building websites and doing development work, so I can use that to my advantage, do these little one-off side gigs, and then use those profits to fuel the speculative trades, okay? And the fuel for that speculative trade is not going to come from the investment side of things, okay? All the dividend positions that I have are staying right where they're at because I want those to do a job over time, and I can't do that if I keep interrupting them and saying, hey, come over here, I need you to do speculative stuff, right? And portions of them might be lost as well. So not exposing any of that money to risk, and that guarantees that every month I don't have to start back at $0 like most new traders do that blow up their accounts. I start at least 70% of what I've contributed plus dividends plus the passive growth, okay? So with that said, let's look at the actual portfolio here. So today's an important day for CRBG. This was a special dividend, so I have it pulled up here, and you can see that there is a special dividend payout per share of $1.16 per share. Now, there are some important elements here that I need to kind of talk about because not a lot of people fully understand the dividend calendar. So let's go ahead and dig into that. So on the chart here, this is the daily chart for CRBG. It's Corebridge Financial. You can see I've drawn 3 vertical lines. I have my position up here, and then there's a little white box right here, okay? And what this means is the blue line is the ex-div date. Okay, there's 2 important dates when it comes to dividend eligibility. That's cum dividend, which means with dividend, and that's just the status that the stock is trading with a dividend being offered. And then there's ex-dividend, which is the first date that the stock trades without offering a dividend, okay? So in order to be eligible for a dividend payout, you need to buy the stock before the ex-div date. You can't buy it on the ex-div date. So in this case, the ex-div date was 11/9, so I had to have bought it on the last day, cum dividend, which is 11/8, which is where this white box is. So that means that when the dividend is announced, the declaration date, I have from then until the day before the ex-div date to buy that stock. Okay, so I could have got a cheaper price here, but I only wanted to throw in 1 share just for demonstration purposes. And typically, the stock does tend to drop by the dividend amount. That's just a factor of the market. It's people taking profits. It's, just those little adjustments, right? So I'm not really too worried about this because I know, remember, when I get a dividend payout and I trade a dividend position, I have two separate elements that I need to consider. Okay, the first is the dividend payout itself. Okay, that's taxed as income. So I need to make sure that that's offset or that I'm aware of it so that I can set aside some money for taxes if I need to. The second part, and just to clarify, it doesn't even matter if you reinvest that, because even though you're reinvesting it, you're still realizing that profit when you get the payout. Okay, so it's not something you can control. If you receive a dividend payout, with very few exceptions, you're still liable for taxes on that payment. So just be aware of that. Always, again, talk to a locally licensed tax professional for that. Don't trust some guy on YouTube's word for it. You know, I can only tell you what works for me and my education. Okay, I can't tell you how to do your taxes. I can't tell you what works best for you. Okay, and the other part of that, aside from the dividend payout and the tax liability associated with that, is the realized P&L from the position itself. Okay, because remember, you're still buying and selling shares. So in this case, I have one share. Okay, my average is $20.45, and I'm getting $1.16 per share, which is 1 times, on this one share after I sell it. Okay, so that means that if I realize a loss of $1.16 per share, okay, I get to claim 100% of that loss. So I get to claim $1.16 and losses, but I only have to pay taxes on 37% of the dividend. So overall, it works out, right? But that doesn't always help us in short term. Short term, we want to get that profit and the dividend payout. Ideally, the realized profit on the shares outperforms the dividend payout. So this brings me to my next point, the date of record. Okay, and this is something that there's also a little bit of confusion on. So in order to be eligible for the dividend payout, you also need to hold the share on the date of record. Okay, because at the end of the day, the company that's issuing the dividend, it's separate from the exchange. It's separate from the stock listing. It's a direct company payout. Okay, they're going to look at the exchange and they're going to get a list of all the people that are eligible that are still holding the shares at the end of day on the date of record, and they're going to stamp their name in a book. Okay, and that book is then going to distribute a bunch of payouts, typically through a broker, but there's various ways you can collect. And then that is what determines your eligibility. So there's a period of holding that you need to satisfy. Okay, you need to buy it before the ex-div date, and you need to sell it after the record date. Okay, so that's this yellow line here, which is today, 11/13. Okay, which means that tomorrow, or at the very, very end of the day today, I can sell this stock. Okay, I'm not going to, because I always like to play it safe, and I like to just sell it the day after just to be 100% safe. But I've bought it before 11/9, and I'm selling it after 11/13, so I'll sell it tomorrow or sometime after tomorrow. And that's a 4-day holding period, which is over the weekend, so I'm okay with that, right? And then the payout date, which is when you actually get paid, that's 11/22. So that's this green line over here. So this is the holding period. This is the payout date. Sometimes they're like the day after the date of record. Maybe they're 2 days, 3 days, 4 days. This is a little over a week. So it's pretty far out, all things considered. But it is also a special dividend. The company has a bunch of offerings. Their finances are a little bit chaotic, so I don't expect them to be able to pay out the next day. Now, if you have a broker that requires your money to settle when you get the dividend, it might take even longer. Some brokers take like an extra week. I think like TD Ameritrade takes a while. I think I'd have to double check on that. But just be aware that that is also a factor in some cases. So just kind of be mindful of that. The stock price at the announcement of the special dividend was $20 per share. I got it a little higher just because I wanted to get in and demonstrate things. Now, if I wanted to get a cheaper price, I would have just traded the chart. Obviously, there were 2 gaps here. Price was falling down. I could have just added more to it. But again, I didn't want to, and I didn't have any extra speculative income because I blew it all on SPX, taking that calculated risk. So it is what it is. I'm not going to let FOMO or hindsight beat me up. Because I get that tax advantage, and that is delicious, especially when you're higher up and you don't really have, you have to hunt for deductions. So I always try to max out my deductions every year towards the end. So that's where tax loss harvesting comes in. And then of course there's business deductions and stuff like that. But for the sake of doing things the right way, at the end of the year, I typically just take a bigger loss on either one of those just to kind of round out my losses for the year. All right. So now what am I going to do with this position, right? Because you can see it's going up. It's got a little bit of a weird flag forming. It's kind of a situation where we're kind of price locked. Just because I can sell after the record date doesn't mean I have to, right? Because this is still a position. It's still something I can trade, which means I don't have to sell it if I don't want to. So what I'm going to do, right, rather than just blindly selling it tomorrow just to lock in the dividend, because the dividend's already guaranteed as long as I hold it through the end of today, right? So after that, I just need to consider the position. So what I'm going to do is I'm going to set a stop loss right here below this low on this position for going forward, because this thing could, in theory, continue to move to the upside. And that will get me my desired outcome of having the dividend payout plus a P&L, or at least a break even on my share prices. Okay? Because remember, if I break even or I make a small profit, I'm only responsible for 37, roughly, myself personally, for about 37% of the profit that I realize, but I can claim 100% of the loss. So if I break even, I'm only really responsible for the dividend payout, right? And then I just don't have a loss in this position to offset that. So that's where the loss on like SPX comes in, because it just makes sure that I have my maximum deduction for realized losses for the year. All right. So this is something I plan to incorporate a little bit more in this portfolio, just because they're easy to trade. You just look for a price between the declaration date and the ex-div date. Make sure you're 1 day before the ex-div date. And when I say you, I just mean in general. Again, I can't give tax advice legally. So just kind of follow your trading plan and consult a financial advisor if you're unsure. But in order to receive that dividend payout, you need to buy it before the ex-div date. Okay. So once you find the declaration date and you get the ex-div date and you know you got to buy it 1 day before that, this whole range right here becomes speculation territory for you to get a lower price. Okay. So if you see a candle, you could place your buy stop right above it, for example, and then say, okay, it's potentially going higher and I want to lock in that dividend. So this is where I'll place my first buy, right? If the candle goes lower, you can set a stop loss above that one, or I'm sorry, a buy stop. If it goes lower, you can place a buy stop above that. If you identify a support level, you can place a level there. You can go down to the lower time frames and identify a trend. So if I go down to maybe the 15-minute here, you can see we've had lower lows, lower highs, all that good stuff. I could have placed a buy down here. I could have placed a buy on this break right here, just in case it did push up, right? Because again, the priority here is to lock in the position. It's not so much to get the best possible average. That does help, but the priority here is to lock in that position, okay? Because if I got my place here in 1931 and the price was to drop, you know, $1.16 from the $20 level that it was announced at, I'd be within that dividend range, which means that I would be able to endure that dividend price fall off and still potentially realize a profit easier. Okay, so hopefully that makes sense. I can always cover it in a little more detail in future videos. But speaking of dividend payouts, let's go ahead and look at what else we got on the horizon. So this week, the week of the 13th of November, if you're watching this in the future, I have no dividend payments coming in today or tomorrow, but on Wednesday, I get 77 cents. And again, that might not seem like a lot, but it is for one position here with 3 shares, right? So 3 shares gets me 77 cents, and it's a position that I'm building over time. It's for Realty Income Corp, or ticker O, okay? And then Thursday, and actually Wednesday morning, I'm not going to be around, so I'll just be making money for doing nothing. And again, that's the entire last week I've done that. I made $2.09 on a Monday, last Monday, with 0 speculative dollars, okay? Didn't trade at all. And then Thursday, I have another $7.60 coming from Tesla, TSLY, and that's only 13 shares, right? Some of these guys have hundreds of shares, some have thousands. I have 13 because I'm on a small account. So for the week, that's a total of about $8.37, again, for doing nothing. Okay, so if I just punch that in really quick, $8.30 divided by, what is it, 1388 times 100. It's a little over 0.5% for doing nothing, right? In 1 week. Now, granted, this is over the course of a month, but you can see now I've got at least one payment coming in pretty much every week, right? Whether it's a contribution first week or subsequent dividends on the other weeks. So we're starting to roll these things nicely. And then next month, we have, let's see if I can skip that. There we go. We've got some of the bigger payments coming in from the quarterly stocks. So we've got quite a bit more coming in next month. Now, again, this is on a small account, so the amounts are very small, but respectively and relatively, they're very good. Because remember, if we look up here, our estimated annual income is about $244, which is about 20% of the account per year. Okay, and again, most financial brokers, they get about 5 to 8%. Hedge fund managers, 5 to 8%. Bank account gets you about 2%. So I'll take 20%. And again, this is without having to take a whole bunch of huge risks. And if I didn't want to speculatively trade at all, obviously this number could be higher, but that doesn't make for a very engaging series. So I want to make sure that you guys are aware that the focus here, the emphasis for the bulk of the capital is still in passive income, because despite no matter how well or poorly I do on the speculative side, I don't have to worry about it. So one more thing that I just want to walk through really quickly is one of the team members, the Rags to Riches team members spreadsheet here. So at the bottom here, you can see all the participating members that are on the team, and we've broken it down month by month. This is mine. I just kind of walk them through how mine is set up and kind of set them up with a little template that they can follow. I think I have to update my November one. I think I bought another share or something, but I might have already updated it. But anyway, back to Chris M. So he and I actually had a voice chat, a little one-on-one session last week, and he's got a really solid plan going forward, and he is not going to be speculatively trading. So you can see on his spreadsheet here, the way that he's broken it down is he's got long-term dividend holdings. These are ones that he does not intend to sell. He's just going to accumulate as many shares as he can. Now, these obviously are not high yielding. They're not very aggressive, but they are stable. And that's the entire point of these. It's just to accumulate as much passive income. You know, these aren't going to pay themselves off in 2 years. They're longer term holds, but they're stable and they have a lot of growth potential. So I like this. Short-term dividend holdings, these are the more aggressive ones that he plans on buying and still accumulating a lot of, but may need to be sold at some point if the price, you know, fluctuates too drastically, or if there's some other situation with the dividend, which now these are ETF, dividend-specific ETF, so I doubt they're going to be cut, but that doesn't mean there can't be volatility in the price, and we don't necessarily want that if we're looking to trade with stability. So, and then here at the end, he's got his non-dividend holdings, and these are just trades that he's going to be looking to accumulate for growth. And a lot of that is going to be based on the Rest to Retire stocks. So in lieu of speculatively trading and looking at charts and trying to, you know, identify candle patterns and zones and all this and all that, he's still going to be doing that as he learns. But he's going to be using the Rest and Retire stocks instead as placeholders and long-term growth. Just because, you know, he's busy, he can't trade, he doesn't want to chart all day, he doesn't want to become a slave to the market. And as far as his overall strategy goes, he's putting in twice as much as I am, which a lot of these guys are you know, using much bigger accounts, and I have a much larger account myself. But for the sake of this demonstration, this 5-year series, I wanted to keep it somewhat in the realm of attainability for most new traders. So $500 again. For monthly contributions is pretty high, right? Because most people are, you know, if you're watching this especially, most of you guys are probably struggling to pay your rent. You're living paycheck to paycheck. You're tired of working so much. You know, maybe you've tried it in the stock market. Maybe you got your butt handed to you, and now you're looking for something a little more stable. That's why I'm doing a $500 monthly contribution, because it shows enough growth to demonstrate the power in the strategy. But it's not too much money where it's just like, I could never do that because I don't have, you know, an extra $2,000 a month. So again, $500 is still pretty high, but these guys have different budgets and different purposes. My purpose for this is to demonstrate value and demonstrate strategy. Their purpose is to gain financial success. So they're fully allowed to just use higher amounts as much as they want. As I do in my larger accounts. Okay, so I just want to make that clear as well. Okay, so he wants to keep $500 cash on the side just for emergencies or just for really, really good opportunities. And that's always a good idea because most brokers now offer some sort of interest on settled cash anyway. So why not just have that as another, you know, passive income position? Even though it's a smaller percentage amount, the opportunity there is still to have that money available for really, really good opportunities. Now, I don't expect anything chaotic to happen, but it is still good to have, you know, even if it's something like just finding a really good special dividend that offers maybe a 40% payout or something. Anything can happen in the market. You could have a really drastic sell-off followed by a really beautiful recovery. And if all your money's tied up and you're someone who knows that you can trade it with confidence and safety and have a tight stop in place and all that good stuff, If you don't have that cash available, you're going to sit there and regret it. And that's okay, right? Not everyone needs to trade emergencies and opportunities, but for those who are interested, it's good. Plus, if you ever just need to pull money out of your portfolio, it's good to have that available, right? I know Robinhood, they give you that card you can use. That's a really cool advantage. But if you're on Webull and you just want to pull money out, like if there's a small family emergency, or maybe you have an issue with your bank account, or anything can happen, right? Things happen. So why not just keep a little bit of cash on the side? Okay. It's just good risk management. It's good to be prepared. So as he deposits, he's doing a 50-50 split for his monthly contributions. 500 of it is going towards longer term safe investments, and the other 500 goes towards the dividend plays. So he's doing like a half and half between the dividend growth positions and rest and retire plays. Okay. And then for his long-term investments, 70% are these long-term dividend holdings. Okay. So he's putting the bulk of it into that longer-term stable growth. 30% goes into the more aggressive dividends that he may or may not need to sell within a shorter time frame. And then all of his dividends, 100% of his dividends, are going right back into his portfolio. Okay. And we talked a little bit about tax stuff and all that good stuff. So I think he'll be fine as far as the dividend tax burdens and stuff like that, because he's not really selling a lot. So he may still need to use the tax loss harvesting at the end of the year, just to make sure he has enough to offset those burdens. Because again, you don't have to sell anything ever, even for a profit. So if you just are buying shares and not doing anything other than collect dividends, you don't have any tax burden other than the dividends in that case. In most cases, I should say, because there are still some exceptions where collecting stocks count as a realized blah, 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 right? So again, always check with a professional, because every circumstance is different. But if in general sense, if you're not buying or if you're not selling anything for a loss or a gain, in this kind of scenario, the only real tax burden that you would have is the dividend payouts that you're receiving. So if you're getting a lot in dividends, that can potentially be a lot of taxes. So it's always good just to have some sort of ability to offset. So if you know that your dividend payouts are going to exceed, or let's say you're making $5,000 in dividend payments for the year. Okay, doesn't seem like a lot, but it might be. You're responsible for 37% roughly in most cases of that, because it's taxed as ordinary income. Okay, 35 to 40% roughly. So if you know that, if you can track that and keep an eye on it ahead of time, you know that you would need $5,000 worth of losses to offset that, or realized losses, I should say. So why not take that small hit on the speculative trades, offset all of that tax burden, and then you can always just use that cash to re-up again and put it right back into your portfolio. So there's a couple little tricks we can use when it comes to the government collecting its tax money that work in our favor. And that's what companies do. That's why you see a lot of the institutions doing tax loss harvesting and all that good stuff. So very important to know all the rules and to know all the moves you can make. But it seems like he's got a pretty solid strategy. And here are his rules, his investing rules. No day trading or swing trading. He doesn't want to deal with the speculation. He just wants to do things that make sense with strong financial companies that have good growth potential, and no crazy catalysts or no uncertainties that might potentially work against him. Obviously, there's no guarantees, but he's doing as much as he can to take the power out of his own hands, because he knows that he's likely to hurt himself. So he's not going to day trade or speculatively swing. He's just going to continue learning and letting this kind of grow in the background. Okay. He's also not going to trade crypto. I personally don't trade crypto. I traded it a little bit back in 2020, but I live in New York and there was a bunch of red tape and all that good stuff. So it just wasn't fun for me. And I just don't feel like getting involved with it. If I'm going to do something like that, I'll probably just go back to Forex, but I don't need to. I make plenty of money in the regular market. So it's no biggie. All right. The last rule here is I must record each time I buy. Okay, and that is important. If you develop a system and you document your stuff, that has tremendous value, because you can identify your own patterns. You can identify what compelled you to buy, and it also helps you at tax time. And it helps you just keep track of your finances in general, right? If you think about the stock market and your portfolio as a savings account, you want to work it like a budget. Okay, so obviously if you're looking at your savings account and you notice a whole bunch of weird expenses, Not just groceries, rent, mortgage, phone, all that good stuff. But you notice something weird, right? It can help you identify that something abnormal is happening with your savings account. Okay. If you notice excessive withdrawals, right? You might have a talk with whoever else has access to that account, and see what's going on. Or if it's yourself, if you just find yourself compulsively buying things and hurting your savings account, it's important to have that talk with yourself, right? So your portfolio is no different. If you're just randomly buying stocks, or if you feel like you set a hard stop and say, oh, I'm not going to day trade at all, but this Tesla play, you're going to hurt yourself. So it's important to make note, not just of your deviations when you break your own plan, but every time you buy and sell, just to make sure that you're on the up and up when it comes tax time, so you don't hurt yourself with surprises. Okay. It's better to do it over time than all at once towards the end of the year and start panicking and having to set aside time to go through all your trades. And it sucks. So just do it as you go. Just keep a running ledger and you'll have a better time. But yeah, I thought that was pretty cool. I'm impressed with the way he's built his strategy out, and I look forward to seeing where it goes. And again, here's the dividend calendar. I'll just move that back here. For November, this Thursday, I will be getting roughly $8.30, and then next Wednesday, which I won't be here in the afternoon on next Wednesday, that's when I'll get that special dividend payout of $1.16. So again, it doesn't seem like a lot, but it does add up nicely. Okay, so at the end of the year, I'm looking at $244 plus, right? Because this doesn't include future contributions. It doesn't count reinvesting the dividends. It doesn't count any speculative profits being put into the investment side. So, you might scoff at $20 and say, oh, that sucks. That's not going to pay my bills. But if you do this over the course of 5 years and that compound reinvestment kicks in and you don't necessarily need to be taking losses at the end of the year to offset your stuff, it's going to add up nicely. And going into next year, I will be tracking all of my P&L on these accounts, and I'll update you guys on these episodes. So I'll include quite a few extra goodies here that you guys can start putting in place for yourselves as well. But with that said, this video is 27.5 minutes long, so I'm going to end this here. I appreciate it, and I will see you guys later. Thank you and goodbye.